Wall Street, October 2025. The city pulses with energy, its iconic skyline gleaming in the autumn sun. In the heart of the financial district, anticipation hangs thick in the air. The market is euphoric, with stock indices at record highs, fueled by the promise of artificial intelligence. Every tick upward is met with cheers, as if the future itself is being rewritten in real time. The AI boom isn't just a boardroom buzzword, it's everywhere, from trading floors to dinner tables. Everyone wants in. From seasoned investors to first-time buyers, the sense of opportunity is contagious, spreading far beyond Wall Street's boundaries. Stories of overnight fortunes and soaring tech stocks create a powerful feedback loop. More buyers, higher prices, more hype. Social media buzzes with tales of instant wealth, and news outlets can't keep up with the latest success stories. It feels unstoppable, echoing the roaring 20s, another era of innovation and wild speculation. The parallels are uncanny. A new technology, a surging market, and a collective belief that this time, things are different. But beneath the celebration, anxiety grows. Whispers of caution ripple through the crowd, as some remember how quickly fortunes can turn. Are we witnessing a true revolution, or are we repeating history's mistakes? The ghosts of past bubbles linger, reminding us that euphoria can blind even the most experienced. The line between a genuine boom and a speculative bubble is always clearest in hindsight. Today's optimism could be tomorrow's regret, and the warning signs are easy to ignore when the music is still playing. AI's potential is real, but markets have a habit of inflating hope into frenzy. The promise of transformation is powerful, but so is the temptation to believe that the good times will never end. As we ride this wave, we must ask, are we investing in the future or dancing on the edge of a cliff? The thrill of the ascent is undeniable, but the risks grow with every step higher. The exhilaration is palpable, but so is the risk. For every winner, there's someone wondering if they're too late, or if the fall is just around the corner. The question isn't just about technology, it's about whether we're ready for the consequences if the music stops. In the end, the true test will be how we respond when the tune changes, and whether we've learned from the echoes of the past. To truly understand the risks we face in today's financial world, it helps to look back nearly a century to the 1920s, a decade marked by dazzling innovation, wild speculation, and the easy flow of credit. The era was alive with optimism, as new technologies and industries promised to reshape society and create wealth for all. The stock market soared almost 90% in less than 2 years, driven by the excitement of new inventions and a surge in borrowing. Investors, both big and small, were swept up in the euphoria, convinced that the good times would never end. Ordinary people, many with little financial experience, bought stocks on margin, borrowing money to invest, believing that prosperity was now a permanent feature of American life. The dream of quick riches was suddenly within reach for millions. This democratization of investing, while exciting, introduced massive risk. With so many betting on the same outcome, the entire system became fragile, vulnerable to even the smallest shock. Fast forward to today, and we see echoes of that era. Zero-commission trading apps and meme stocks have brought speculation to the masses once again. Artificial intelligence is the new radio, promising to revolutionize markets and create fortunes overnight. But in 1929, the music stopped abruptly. Margin calls triggered a wave of forced selling, prices collapsed, and fortunes that seemed secure vanished in a matter of days. The shock was swift and devastating. The aftermath was the Great Depression, a harsh, unforgettable lesson in the dangers of unchecked speculation and excessive leverage. Lives were upended, and the economy took years to recover. When markets are driven by hype, easy money, and debt, corrections can be sudden and brutal, leaving little time to react or recover. The parallels between then and now are striking. Are we, perhaps unknowingly, setting the stage to repeat the same cycle of boom and bust? History warns us, unchecked speculation and the belief that markets only go up rarely end well. The past is a powerful teacher if we choose to listen. The AI boom is the engine of today's economic growth, powering a new era of innovation and ambition. Across the globe, companies and investors are racing to stake their claim in this technological revolution, hoping to ride the next big wave of prosperity. The sector is attracting hundreds of billions in investment, as capital floods into AI startups, research labs, and infrastructure projects at an unprecedented pace. Tech giants like Google are making real massive bets. $85 billion for AI infrastructure alone. These investments are reshaping the landscape, fueling a race to build the fastest chips, the smartest algorithms, and the most powerful data centers. The productivity gains are real, with AI transforming industries from manufacturing to healthcare, automating tasks, and unlocking new possibilities for growth. But so is the frenzy. Startups with no revenue are valued in the billions. FOMO is rampant, as investors scramble to get in early, hoping to discover the next unicorn before it takes off. In this gold rush, discipline is fading as money chases the AI dream, sometimes with little regard for fundamentals or long-term sustainability. The market is pricing in flawless execution, leaving no room for setbacks or delays. Every new breakthrough is met with soaring expectations, and any stumble could trigger panic. If AI's promise falters, the consequences could be severe. A single sector now props up the entire market, making the system more fragile than ever. The sugar rush could end abruptly, exposing a weaker economy beneath, one that's become overly dependent on the success of a handful of tech giants and speculative startups. AI is transformative, with the potential to reshape society, but are today's sky-high valuations grounded in reality or drifting into fantasy? The line between optimism and speculation is growing thin. The stakes are enormous and the risks are growing. Every decision made now could echo for years, shaping the future of the global economy. The question isn't if AI matters, it's whether the market's faith is justified or if we're building an economy on silicon dreams that could vanish overnight. After the 1929 crash, financial guardrails like the SEC were built to protect investors and ensure transparency. But in recent years, these protections have quietly eroded. Deregulation, weaker disclosure rules, and a gutted Consumer Financial Protection Bureau. This is happening just as speculative risk is surging, fueled by AI and cryptomania. The rules meant to temper excess are being dismantled as the market accelerates. Risks now grow in the shadows, harder for regulators to spot. For ordinary people, this isn't abstract. Weakened protections mean greater exposure to market volatility and predatory practices. We're dismantling the firewalls that shielded us from past crises, just as a new fire is building. The timing couldn't be worse. A new push is underway to let ordinary Americans invest their retirement savings in high-risk private markets, venture capital, private equity, and AI startups. The pitch: democratize access to explosive growth. The reality: private markets lack transparency and are far riskier than public stocks. Most startups fail, and losses can be total. Yet, 401k plans may soon be exposed to this volatility. Industry leaders like BlackRock's Larry Fink champion this shift, calling it diversification. But it's really a dramatic escalation of risk. The system once shielded retirement savings from speculation. Now, those walls are coming down. A crash in private markets could devastate millions of retirement accounts. The stakes for ordinary families have never been higher. This is a dangerous gamble with America's financial future. The market's surface strength hides growing volatility and a widening gap between winners and losers. Alphabet, Google, is thriving, investing billions in AI and reinforcing its dominance. Meanwhile, Tesla, once unstoppable, faces revenue drops, fierce competition, and fading tax credits. The AI boom isn't lifting all boats. It's concentrating gains in a handful of mega-cap tech giants. This concentration is risky. If one giant stumbles, the whole market could feel the shock. The S&P 500's health now hinges on a few companies. Creative destruction is accelerating. AI will create winners and losers, often overnight. Tesla's struggles show how quickly fortunes can change. Hype is dangerous. Fundamentals matter more than ever. In this market, speculation is rewarded, until it isn't. If AI is a speculative rush with real roots, crypto is pure speculation, unregulated, volatile, and often absurd. Meme coins and joke tokens like Sorkin coin can see hundreds of millions in trading volume overnight, then crash to zero. This is gambling, not investing, driven by the hope of finding a greater fool. Mainstream finance is legitimizing crypto, drawing in more retail investors and amplifying risk. The Sorkin coin episode is a microcosm. Real money lost on a joke, detached from any value. As more people pile in, the potential for widespread harm grows. Crypto's wild swings could trigger a broader crisis of confidence. The bubble is inflating. How long before it pops? At the top of finance, there's a stark divide: caution versus optimism. I see echoes of 1929, markets propped up by a single narrative, eroding protections, and rising risk for everyday investors. My warning: a crash is coming, though timing is uncertain. Larry Fink of BlackRock sees opportunity, democratizing access to private markets and crypto, betting on AI as a true economic revolution. This isn't just debate, it shapes policy and investor behavior. Fink's view supports tearing down guardrails for growth. Mine urges reinforcing them for stability. Even experts disagree, perhaps the clearest sign of heightened risk. Investors must decide which vision to trust as the stakes rise. What should the average investor do amid hype and warnings of a crash? The answer: proceed with caution and discipline. Resist the lure of trends. Don't buy just because something is hot or has AI in its name. Focus on fundamentals: strong companies, real earnings, and sustainable models. Diversify across asset classes, industries, and regions. Don't bet everything on tech or crypto. Know your risk tolerance and time horizon. Never invest money you'll need soon. Avoid leverage. Borrowing amplifies losses as much as gains. Stay informed, but don't panic during downturns. Corrections are part of the cycle. Have a long-term plan and stick to it, even when markets swing wildly. The boom may last, but discipline and diversification are your best defense if the music stops.